Renowned Tesla bull after meeting GM CEO Mary Barra last year, Cathie Wood betrayed Tesla by buying some stock in GM. But if the most recent news about General Motors is any indication, her betrayal will cost her dearly this morning. Some new information has surfaced that highlights areas of significant struggle for the automaker. These struggles could be a sign of bigger issues to come later this year and into the decade. GM's collapse is knocking on the door, and Cathie's $13 million investment could go to zero. Renowned investment analyst Jim Cramer called this a year ago when Cathie bought GM shares for the first time, and Cramer himself stated that Cathie's support for GM would be a kiss of death for the company. But before we get any further, smash that like button and sign up. The GM is currently offering buyouts the majority of its U.S. salary workers. That is just the tip of what is lurking within the automaker company. Essentially, GM is looking to cut about $2 billion this year. And one way they're doing this is by offering employees the opportunity to leave. We've seen this with other automakers, and it was just a week and a half ago that GM announced the elimination of about 500 salary jobs around the world. Now, the company is sending out offer letters to almost all of its salaried staff. How many people will take the buyout and whether or not this will keep the company from having to initiate broader layoffs remains to be seen. Let me walk you through what I think is going on. Based on GM's Q4 earnings performance, they had flat sales in North America quarter after quarter, but there was an increase in inventory buildup in the same region. This means that they sold out the same number of cars, but the dealership inventories grew. Essentially, the net sale of cars sold to customers in Q4 were less than in Q3, even though GM recognized it as a sale in their earnings report. All they did was move inventory from their factories to the dealership network. Dealerships, particularly those selling GM, have an abundance of inventory. While the auto industry has been slowing down since November, brands like Buick Cadillac and GMC Chevy had a healthy supply of 60 days of inventory. This is not good news for GM, as there is a serious issue in hand. GM had to halt the production of their best-selling truck because the dealerships had too many cars in stock. It's a tough issue, because GM generates the majority of its money from SUVs and trucks. They're suspending production on the one thing that's bringing in the most revenue: legacy stock. This may have been portrayed as an increasing output amid steadying demand, but in reality, people are just buying less vehicles. Since pickup trucks are the most expensive cars on the market and automakers like GM rely on them to turn a profit, 2022 is not looking good for Cathie and her ARK Invest money. In a report outlining the company's recent trades, Cathie Wood's ARK Investment Management disclosed that it had purchased 158,187 shares of General Motors (GM) for its autonomous technology and robotics ARK fund, signaling a shift from her previous criticism of traditional automakers. According to Forbes, a well-known stock picker who specializes in cutting-edge companies oversees almost $60 billion in assets for her company. Even though they had previously criticized traditional automakers, ARK Investment Management, in a recent interview with Yahoo Finance, Wood expressed her admiration for General Motors' advancements in electric vehicles, autonomous driving technology, and its San Francisco-based Cruise subsidiary. She also mentioned that the company's electric vehicle initiatives were discussed, and the firm was considering investing in GM while remaining open-minded about it. Wood also emphasized the significance of keeping an open mind and acknowledging success, citing GM's focus on Cruise automation and Barra's efforts to turn. It's hard to ignore the massive slowdowns and layoffs that are looming for companies like GM. However, slowdowns are inevitable. The key question is what the next cycle will be and how it will affect car companies. In my opinion, there are two clear contenders for the next cycle: compelling EVs and affordable cars. With the FED tightening rates and people struggling to make ends meet, this is a notable shift from Wood's earlier criticism of GM and Ford's plans for electric vehicles and her prediction that they may go bankrupt. It should come as no surprise that Tesla was the only automaker in the U.S. to expand annually in 2022. This shows that EVs are clearly replacing gas-powered vehicles, and the trend is just getting started. Nevertheless, there is a substantial demand for reasonably priced vehicles, especially EVs. Where is GM stand in all of this? It appears like they're in difficulty, even though there are some reasonably priced EVs on the market, such as the Chevy Bolt. But it's not without its problems. If automakers can't supply this, they risk slipping behind. The car experienced several recalls before it was purchased, resulting in production halts, layoffs, and delays. It's obvious that GM needs to change and produce attractive, reasonably priced EVs if they want to remain relevant in this shifting market. DM offers a few reasonably priced vehicles that might assist them in achieving their objective, like the Blazer EV, which has a starting price of $45,000, and the Equinox EV, which will go on sale in the fall of 2023 and has a starting price of about $30,000, is one vehicle they need to increase production of. Other cars in the pipeline include the Lyric Blazer Equinox and Silverado, which should go on sale in 2024 and 2025. As far as inexpensive EV cars go, Tesla is miles ahead of the competition. Elon Musk, the CEO of Tesla, has announced that the automaker's upcoming affordable electric vehicle, EV, will primarily operate in autonomous mode once it goes on sale in 2020. Although investors had anticipated more information about the vehicle at Tesla's recent Investor Day, none was disclosed. However, Musk recently gave an update on the car during an interview at the Morgan Stanley conference, explaining that the company has a clear strategy to make a smaller vehicle that costs about half as much as the Model 3 and will operate almost exclusively in autonomous mode. Musk stressed that Tesla needs autonomy and that the company's most notable development to date is the quick development of the fully autonomous system. Cathie Wood has a history of influencing Jim Cramer's ideas, according to the well-known CNBC broadcaster and personality known for his honest assessments of people and stocks. This is demonstrated by her evolving positions on GM and legacy automakers. Wood recently made her first purchase of shares of General Motors on a CNBC episode, decreasing her stake in Tesla Incorporated, a leading electric vehicle firm. This past week, Cramer talked about the faltering stocks of Ford Motor Company and General Motors. He was hesitant to suggest investing in General Motors, citing his concern that Cathie Wood's involvement might have a negative effect. Cramer said, "DM seems to be doing well, but I'm wary of Cathie Wood's involvement, which may not bode well." Jim Cramer, in a recent CNBC segment, advised investors not to buy General Motors shares during a recession, citing the need for more substantial declines before larger investors start buying a stock. Cramer used Warren Buffett's purchases during previous market bottoms as evidence. These remarks came after Cramer had recently criticized Palantir Technologies, a stock linked to Cathie Wood, dismissing it as a company that probably would not have gained much attention if Wood hadn't been involved in a Mad Money episode in January. Jim Cramer recommended that his audience short Cathie Wood and think about purchasing the entire Capital Short Innovation ETF, which is intended to wager against Wood's flagship stock. He attacked ARK Innovation ETF for being the ultimate hedge fund that held traditional growth stocks and for having a drowning scene in the show. But a lot of people on social media quickly brought attention to Cramer's earlier remarks from less than a year ago, in which he called Wood a genius at the height of her ETS performance. The irony of Cramer's suggestion was highlighted by Bloomberg senior analyst Eric Balchunas on Twitter, pointing out that the Woods ETF has dropped by 50% since his initial remark in February 2021. Cramer recommended that Wood should stop making new investments in art funds and instead focus on enhancing performance, as legacy automakers find it difficult to switch to EVs. Early on, there may not have been enough money invested in reasonably priced EVs. What are your thoughts on these concerns? The future of GM and the EV market is unclear, and it's unclear how long their profitability will persist. Tesla, on the other hand, has made significant investments in reasonably priced EVs and could become the dominating competitor. Please feel free to offer your opinions in the space provided below. Thank you for viewing, and please subscribe. We'll see you in the next international video.